I'm going to be talking about the jobs report. We just got the jobs data. This week again we have Powell doubling down on no hurry to cut. Betting markets with Fed fund futures again have us going into a pause in the new year. That's not, well, if they do it, they may do it. A foolish mistake if they did, because recession's about to happen. The herd believes again there's not going to be a recession. We're going to have the soft landing. The Fed believes this stuff. Watch the video all the way through. You'll see the new data simply not what the data is telling us. It's telling us we're about to have a recession. Not just a deterioration with the non-farm payrolls. There are other problems that I would like to address. Please support the channel with the link directly below that allows me to be able to provide you this information. The link will take you to a secured site and you can donate any amount you want. If you could take a moment to do that, I would appreciate it. I'll post another video on Sunday reviewing the stock market data. Very good chance we're going to see a peak in December or January. Reach the target level. I told you I thought we'd overthrow it. Good chance we're going to reach the target level in the weekly time frame, which we haven't reached yet. 6100 area. I'll talk more about that on Sunday. So stay tuned for that. Let me show you other problems beside this data, which I will be talking about and updating you on just a moment. Not only are we seeing a deterioration from 2023 to 2024, there are other discrepancies, other things that just do not add up with these fake numbers that we continue to get. The non-farm payroll showed that we had created 225,000 jobs for the U.S., while the household survey is showing significant weakness, the number of employed people falling by 355,000 in November. Huge discrepancy. Meanwhile, the U.S. lost 111,000 full-time jobs, creating the illusion that we're creating all these jobs. But we've gained jobs, but jobs are being lost. Full-time jobs, 111,000, 268,000 part-time jobs. Another discrepancy. There are now 1.7 million people in long-term unemployment, up from 1.2 million last year. The amount of people in long-term unemployment has sharply increased. Again, the government jobs that were added were a sizable amount. Once again, 33,000. We've seen this over and over again. A couple of months ago, the election, the government jobs created half of the jobs created. Seen this over and over again, but something just does not add up here. And again, the labor data that we're getting are telling us that recession is coming. There's clearly a deterioration in the labor market. The household survey, the number of full-time and part-time jobs being lost, and long-term unemployed are not in harmony with the bogus numbers that we've been getting out of the Labor Department with the non-farm payrolls. Something doesn't smell right. Likely by the end of the year, we're going to see a lot more revisions where all is said and done. But the labor data that we're getting also is warning recession is coming. We're also getting all these warnings of more and more layoffs. Now, we got the jobs report in on Friday, and it came in stronger than expected. More about that in a moment. Earlier in the week, we had Jerome Powell speaking and a Q&A. A couple of important takeaways. First, one thing, Powell saying, the debt is unsustainable for the U.S., and we need to change course on this. Why didn't he say this years ago? If that's true, why does the Fed do QE, which enables the government to spend like drunken sailors by the Fed buying up a lot of the debt? That is one of the reasons that has given us the bubble that we're in right now in the stock market. Nevertheless, I digress. Powell doubled down previous statement when he said that there's no hurry to cut rates. A good place. The economy is strong, and he doubled down on that this week. Powell says the economic strength gives the Fed the ability to take time on rate cuts. Again, I don't know what Powell is looking at, and I don't know what is causing Powell to think that. Is it the election with President Trump talking about tariffs or implementing certain economic policies that Wall Street has been applauding? Is it yields that is causing him to second guess himself? Is it fake numbers that we're getting out of the Labor Department with the jobs reports? Got another one today. I don't know what's causing Powell to second guess himself. The narrative now is, oh, we're going to get another cut out of the Fed, December, but then the Fed is going to pause and we're going to take things slowly. And we're seeing that reflected in the Fed Fund futures, which fluctuates every single day. It's the narrative right now. Oh, the Fed's going to do one more cut in December, but then they're going to pause. Again, the Fed is making the exact same mistake that they made in 2007. Right before the recession, the Fed was focused on inflation. It had already started cutting in October of 2027 with 0.5%. Then they did a quarter, and then they did, I believe, one more quarter. But then they had to do, by January, they had to do a jumbo cut because they were blindsided. Focusing on inflation. Mark my words, inflation's going to go higher, but the Fed is still going to cut. The narrative out today. Now, we had the jobs report come in at 227,000, stronger than expected. Employment rate moved to 4.2%. It was expected we were going to get 214,000 jobs. We got 227,000 jobs. Unemployment rate came in right in line at 4.2% as expected. Still higher, though, than the 4.1% from the previous month. The previous month, we had the data reflecting the hurricanes and the labor strike. Previously at 12,000, it was revised higher to 36,000. I thought that would eventually be revised to a negative number. It still could. We have another revision, and then we have a year-end revision. Wouldn't be surprised at all. But we get these fake numbers out of the Labor Department, and it's the worst I've ever seen. What's been going on the last years with these huge numbers, overestimating the amount of jobs being created and then drastically being revised down afterwards when nobody's looking. We're seeing a deterioration in the labor market from 2022. There were more jobs to lower levels in 2023 down to lower levels now in 2024. We're seeing a deterioration in the labor market. I've talked about the difference between 2023 and 2024, which is similar to what we had in 2007. Seeing the unemployment rate begin to rise off of those previous years. Again, this is what happens. You get a really, really low unemployment rate. As we begin to move off the lows, the stock market begins to peak before we get a spike in the unemployment rate. We will see a spike in the unemployment rate once we reach the recession or just right before it, where we start seeing negative jobs. And again, the unemployment rate has already moved off of lows. The 3-month moving average already moved off of the lows. The 3-month moving average of the unemployment rate already moved over 0.5% off of the lows. No, it's not there right now. It's just under that. It's already been triggered back in July. The July number, which we had in August, 3-month moving average was above, over 0.5% above the low over the previous 12 months. That triggered the SAW rule, which telling us recession is about to begin. It's right around the corner. It's coming. SAW rule has been triggered in the past. It's marked these other recessions accurately before they have happened, and this time is going to be no different. This was a self-imposed shutdown of the economy. We got the inflation because of the Fed and the government meddling with things. The last time around, pandemic in 2020, you had supply chain disruptions, the shutting down of businesses. You decide, to pass out $6 trillion in checks. It's all about supply and demand. But he had a hot little check in their hand to go spend. All the businesses were shut down. We had supply chain disruptions. The Fed lowers rates to nothing. Does QE 2.0. They gave us the inflation. The very people they said they were trying to help. This is telling us, hey, we're going to see a recession. And again, that recession is likely going to hit in the first quarter, maybe the second quarter, probably the first quarter of 2025. And you're going to be 6 months since this recession indicator has been triggered. By April, it will be 9 months. Likely see the recession start. Before the recession starts, the stock market will peak. It's already started cutting rates. Now they're focused on inflation, just like they were in 2007. Powell asked about the SAW rule being triggered. He dismisses it. But the Fed does. Yeah, we're getting this number of over 200,000. What was it? 227,000, I believe. And again, you've got, and just like that number that we had, the September number that we got in early October, everybody's going, oh, why is the Fed cutting? Economy's strong, and we're getting basing it on some fake number out of the Labor Department. Powell doubling down on no rush to cut, no hurry to cut. Powell holding the line that the inflation fight isn't over. He doubled down on that this week, and he stated that just a couple of weeks ago when he told us, oh, there's no hurry to cut rates. Now, right now, the inflation rate is at 2.6%. That was the October reading that we just got in November. We got that in November. We're about to get a number here in December next week. It's expected that the inflation rate is supposed to start ticking higher. And again, I believe inflation is going to start going higher, but the Fed is still going to do cuts, though they're suggesting they're not. They're going to pause. And again, Fed Fund futures would seem to just the same thing. And then all over social media, why is the Fed cutting? What's going on? We got a really strong economy. And again, that's exactly what Powell said at his Q&A there earlier this week. The Fed's going to be blindsided by the recession that's coming, focusing on inflation. Now, this inflation, and eventually they're going to end up doing an emergency cut. We'll likely see that during the first quarter. Recession hits in the first quarter. Likely see that happen. The stock market will probably peak a month or two ahead of the recession. So if we start seeing the stock market peak, again, recession will follow very quickly, probably in the first quarter, 2025. But right now, the inflation is lower than what it was in 2007. The Fed did an emergency cut. They started slashing rates, but they were doing the same thing now. They're doing the same thing now that they did back ahead of that. They didn't see the recession coming. They were, laser focused on, which is higher than the 2.6 we currently have right now. Back in 2007, in October of 2007, when the Fed began to cut, the rate was at the inflation was at 3.5%, went to 4.3 in November. In December, when the recession actually started, it was 4.1%. The inflation was 4.1%. In January, it ticked back up to 4.3% after having that number come in. But the November report came in December. Got the December number in January, 4.1%, and the Fed still slashed by 0.75% and did an emergency meeting, and later did another 0.5%. So they dropped in January by 1.25%. Inflation is higher than it is right now. So I'm telling you, inflation is going to go back up. It is going to tick back up. Fed is still going to slash rates. The narrative is that's not going to happen. Being echoed with today's jobs numbers. Showing you this because the Fed is making the same mistake they made in 2007, focusing on the inflation rather than focusing on the recession that is about to start. 11 months later, after the Fed was cutting, but 11 months after the recession started, inflation was taken care of by deflationary forces. The Fed was cutting aggressively. Inflation eventually collapsed, and it actually we start getting negative readings on a year-over-year basis. Just real fast, back to the takeaways from Powell. Again, Powell continuing to express concerns about inflation. Telling us how strong the economy is. Good place. No rush to cut. They should be slashing rates. And then we get the question about the data. Powell makes an excuse. The Labor Department and why we're getting these fake numbers out of the Labor Department. Again, it's the worst I've ever seen. I've been looking at this stuff for a long time. But then I, again, about fell over. Watching Powell's Q&A when Powell said that the labor data is the best data that they get. Are you kidding me? The constant fake numbers, overestimating, and then revisions, dramatic revisions to the downside. I've said in Thursday's update, no wonder why the Fed doesn't see the recession coming is because they believe these fake numbers. The other takeaway from Powell's Q&A, again, quickly, I'll talk about, that we're in a good place and we can, use our tools and we can respond if we need to, talking about, lowering rates. But he said that we aggressively raised rates when it was appropriate to do so? No, they did not. They kept telling us it was transitory, the inflation was transitory, and they were late raising rates, and then we started getting jumbo rate hikes out of them because wrong, inflation wasn't transitory, and they were late starting the rate hikes. Got those jumbo rate hikes, and if I said rate cuts a moment ago, I'm not sure. We got jumbo rate hikes. Their rate raising campaign. Now they're doing the opposite. Rates too high for too long. They should be slashing rates right now. Recession is about to start. Like in 2007, they never saw it coming. The takeaways from Powell, and then again a couple of weeks ago, Powell said the economy's in a good place. There's no hurry to reduce interest rates. Now, we get this strong jobs report, and all over the internet and social media, the narrative is now that the Fed is going to do one more cut, and then they're going to be pausing. The economy is fine. The economy's strong. They get the inflation data next week, and inflation data ticks back up as, again, I'm expecting it to begin to start to rise back up. The market could sell off. Oh, inflation's coming back up. Fed's not going to cut. Inflation data next week very well could be a catalyst for sell-off. I talked about this earlier in the week about a strong jobs report and inflation coming in hot. Give us the turn next week or after with the Fed the following week. I told you Thursday, the next 2 weeks, one of those events could trigger a reversal and create a peak. Could drag on to January. That's certainly possible. We just hit the objective target level last Friday, on Black Friday, 1 week ago. I told you we were going to go higher than the 6,000, mid 6,000 area there, 6,040 to 50. That on the S&P. Now we're at the high 6,000 area. I told you we were likely going into that 61, high 61 to mid to high 6,100 area, likely to the high 6,100 area because that's where the trend line is in the weekly time frame. Very well could do that going into next week or with the Fed meeting following week. So do keep that in mind. The jobs report here came in at 227,000 jobs. And again, a lot of this, like this jobs report, it was 33,000 of it was government jobs. It's been high in the jobs report, the amount of government job creation over this last year leading into the election. But surprise, the job number comes in powerful, comes in strong for November, 227,000 jobs. Now we had that weaker number of 12,000, again with the labor strike and the hurricanes. That was revised upward to 36,000, which was an increase of 24,000. Again, these numbers could eventually be revised downward. We're going to get another revision, and then we'll have more revisions at the end of the year. I want to say this, from March of 2023 to March of 2024, we were down 800, and we were, rephrase that, the Labor Department had overestimated by over 800,000 jobs, 818,000 jobs. Started making news as headlines showing that figure, and all of a sudden, magically, the revisions, they sharply revised the numbers upward, which again, these numbers are untrustworthy, but they're the numbers that the Fed thinks. Powell said the best data they get. The fake numbers are the best data that the Fed gets. Nonetheless, again, we saw heavy revisions back upward after those horrific headlines. And this is fake numbers and people using accounting tricks to arrive at these numbers. That's all they are. They're not reliable. They're a bunch of phony, fake numbers. Phony, baloney, plastic banana, good time rock and roll, fake, non-farm payroll numbers. That's what this is. So let's be clear about that. I just want to say here, again, we have deterioration in the labor market that the Fed is continuing to ignore. I talked about it weeks ago. New data now with the November data and the revision from October. The previous 11 months in 2023, this black rectangle right here, we had, for the first 11 months in 2023, we had 2,723,000 jobs created, okay? That was for the first 11 months from January to November. Here in 2024, from January 2024 to November of 2024, here with the red rectangle and these numbers over here. During the first 11 months, we've had 1,984,000 jobs created, a total of 739,000 fewer jobs than over here at the 2,724,000 in 2023. The 11 months here, we have 739,000 jobs less in 2024. This is exactly what we saw between 2006 and 2007, right before the recession hit in December of 2007. And the Fed, again, is focusing on inflation, which is higher than it is right now, and not focusing on the coming recession. They were blindsided by it. That's why, once again, the Fed is oblivious, focusing on inflation and keeping rates elevated. They should be slashing rates right now. They've started to cut. Now Powell's second-guessing himself. No rush to cut. There's no hurry. Good place. The economy's strong. The good fake numbers we're getting out of the Labor Department. They're, rather than slashing rates, they're focusing on inflation rather than seeing the deterioration in the labor market. Again, 739,000 is a difference from year to year just for the first 11 months. We saw it nearly 1 million jobs between 2006 and 2007. Nearly a million less jobs were created. This is telling us, hey, recession is right around the corner. Again, eventually these numbers are going to go negative. Well, we're getting fake numbers. Hey, look, they could try to make the numbers look better than they are, but again, the numbers are going to go negative right before the recession hits or when we start moving into the recession, which is right around the corner. Very, very hard for them to try to put out positive numbers when the numbers are going to get extremely ugly. You're going to get some really ugly looking negative numbers for the job creation going forward. You can try to make it look better than it is, but it's still going to be bad. I don't know who's going to be running the Labor Department, whoever does run it in this new administration. Hopefully we get somebody that's going to put a stop to this stuff and we get some actual honest figures, not these bogus numbers. You know, they say figures don't lie, but liars sure can figure. This is the worst I've ever seen it. I've seen bad estimates before, but I mean, this is ridiculous how they way overestimate the number and then revise it down sharply. And again, these numbers will likely end up being this number we got today will likely be revised down sharply. Now, this number right here, by the way, I want to talk about the September number, 254,000 originally. It dropped down to 225,000. Now they've revised it back up and we got 1,000 gain. Again, after the end of the year, we get another revision, and we're going to have these other revisions for October and November on into for the December number, and then they're going to revise things even more. Eventually, we'll likely see even more revisions to the downside. These numbers are unreliable, and they are a bunch of fake numbers, and these are the numbers that the Powell is saying best information that they get to make their decisions. And no wonder why they can't see the recession. Now, I've just shown you, even with their bogus numbers, we are seeing the deterioration, again, the weakening 2023 to 2024 by 739,000 jobs. The same thing happened in 2006 and 7. Again, 2006, we had 2,071,000 jobs created for that year. 2007, again, inflation higher. Right before the recession, it was right here in December of 2007, right before the recession hit. The Fed started cutting the rates in October. Stock market peaked right after that, and we saw the recession ushered in immediately in December. But all the deterioration between 2006 and 7, there were only 1 million jobs, 115,000 jobs created in 2007, 1,115,000, lower than the 2,021,000 by 956,000, almost 1 million jobs lower, which is what we're seeing right now. That's a full 12 months. We only have 11 months, and we're dealing with fake numbers. So again, with fake numbers, we're still 39,000 lower than 2023 for the first 11 months of 2024. That's with fake numbers, dealing with fake numbers. Will probably be something like this after all said and done when we get the revisions. Nobody's looking anymore. This is right before when the Fed back in 2007 was focusing on inflation. than the coming recession. That's why in January, at the emergency rate cut in 2008 of January 2008, after the recession already started, the market from the October peak had dropped by January 22nd when the Fed did the emergency cut 1 week before the meeting, and then they cut another 0.5%. The stock market had already dropped 20.5%. The day they cut, rebounded back up. Oh, it's over. And we got a counter trend, dropping 20.5% from the October high to the January 22nd low. And we got an emergency cut of 0.75 point, and again, got a bounce, and then the crash resumed, as I've talked about. I'm telling you this because, again, recession is right around the corner. Quickly, here is, again, the peak in 2007. We dropped 20.5%. The Fed did an emergency cut here. We got a little bit of a bounce. Then the bottom fell out of the stock market, and we ended up dropping nearly 58%. Believes the rate cuts, this is a Fed funds rate down here, they believe the rate cuts are bullish, the rate cuts are bearish. We had the Psalm rule triggered in July, 5 months ago. We had the uninverting of the yield curve in September. Again, very good chance we're going to see the recession hit in the first quarter, possibly the second, but you got a pretty good shot with the Psalm rule being triggered 5 months ago. We see it in the first quarter. April would be 9 months from when the Psalm rule was triggered, warning of a coming recession. So that would be April, and pretty good chance to see the recession hit before then. Pretty good odds in the first quarter of 2025. Now, we don't have, this is the spread between the 10 and the 2. Again, what we had an inverted yield curve, which meant the 2 was higher than the 10. Now we have the uninversion, which again we're being told, oh, that's the economy's normalizing now. Have the uninverting of the yield curve. It's warning, hey, the steepening of the yield curve is starting to happen here, warning that recession is getting closer. We still have the spread between the 10 and the 3 month still in negative territory. When this goes positive, recession will be arriving at that point very close to the time that this happens. Now, again, remember, the stock market prices in the future. When the recession hits, the stock market will peak and begin to turn down as it did in 2007. October of 2007, the recession hit in December. We got a 20% drop. And again, before the recession hit in 2001, the stock market began to peak in 2000, begin to price that in. I think we'll see the uninverting between the 10 and the 3 month very, very soon, something I've been watching very closely. I'm talking about this stuff because, again, recession is about to happen. The data is pointing a recession, the Psalm rule, the inverting of the yield curve, the deterioration in the labor market. That is doing exactly what they did in 2007 when they were blindsided by the recession back then, too. We're focusing on inflation, which was a lot higher than it is right now. And that didn't stop them from doing aggressive jumbo rate cuts. The narrative is that the Fed is going to give us one more cut in December, and then they're going to pause in January, and maybe we get a cut into the first quarter or at the beginning down to 4% to 4.25%. With Powell saying, oh, there's no rush to cut, no hurry, good place. I'm telling you, when the recession hits, when they finally figure it out, see them doing jumbo cuts. So this is going to go away, and this is what the Fed Fund futures betting markets are expecting, and they're going to go in shock as well because, again, Powell believes that the rate cuts are bullish, and they don't expect the recession is going to happen. They keep telling us we're going to have the soft landing. A bunch of nonsense. And again, it could be the yields that had spiked higher causing Powell to second-guess himself. It could be the election with Trump bringing in the tariffs or his economic policies. The narrative is now that we're going to go into this boom period. Again, recession is about to hit. Any new policies will take time to implement. Wall Street likes Trump's policies, but that's not going to stop the deflationary forces that are now going to begin to be put in place, and the policies that are already in place right now, knowing that the recession is about to start. Again, I told you that the yield here, the 10-year yield was going to start going back down. It has. It came up to this trend line and just overthrew it, tried to get above it a couple of times, and it failed. got above this broken trend line right here and turned down off of this trend line. It's come down, and today with the jobs report came down another 0.69%. And again, Fed funds rate falls. A shorter term yield. This is a longer. Told you again. Eventually, we're going to begin to see the stock market begin to fall. The yields lower. This is the 3-month Treasury yield, and again, follows very, very closely with the Fed funds rate there in purple. Again, I told you the Fed was going to begin to, before they ever did, because again, we had seen it drop below the 50-period moving average here. As it's declining, the Fed funds rate will begin to catch up. So again, stuff about, the Fed's going to pause and all this other stuff. Now, they may pause, but they're going to have to do jumbo cuts to catch up. They make that dumb choice to pause. I wouldn't put it past them. I mean, they make terrible decisions like waiting to raise rates. Clear inflation was a problem, and yet they told us it was transitory forever. But again, this is telling us, hey, the Fed funds rate will start dropping, and eventually the stock market will join the yields, the yield that was rising. Eventually, it will join the 3-month. The stock market will join it, and as the yields dropped, so did the stock market, 51%, 58%. I'm telling you, if they make the dumb decision not to continue to cut rates, and they're already making horrible decision and not slashing the rates by ignoring the warning signs of the recession, they make the horrible choice of pausing. Again, we can see the inflation data begin to tick back up as soon as next week. Could be a catalyst for the sell-off. It's not going to cut. The Fed is going to cut. Even in 2007, or early 2008, I should say, they cut, even though inflation was higher than it is right now, much higher, because the economy was slowing. Again, over social media today and with the jobs report, the Fed, we're going to get less cuts out of the Fed. The Fed's going to pause. That's the narrative right now. The herd is looking at inflation. The Fed is looking at inflation, and they should all be looking at the recession, not the inflation coming. Inflation is going to tick back up, and I'm telling you, it is going to tick back up. Eventually, the deflationary forces will take care of it. So again, eventually, the market is going to join the yields in dropping, and we've now seen the 10-year start to drop. The market will peak out and begin to drop soon. Continue to say, I believe we're going to new all-time highs. I talked about my target levels, and I talk about more about that later this weekend.